Well, a very good welcome to everyone to the first session to the Intro to Investing workshop today. I'm thrilled with the material that we have today because it's the first time that we've had the opportunity to present this type of financial wellness material. And so you've got a big day ahead of you today. We're kicking off this session. This is Sound Steps. Financial wellness is every investor's starting point. And this really is laying the foundation for you. We're going to talk about a number of different things here, but let me get some of the housekeeping stuff out of the way first. Of course, everything that we talk about in this session is for educational purposes only. Nothing should be construed as a buy or sell recommendation. But in any event, I'm thrilled to have a guest with us here today. Aaron Harding is a managing director with Morgan Stanley. And, Aaron, I just, let's turn it over to you. Tell us, give us a little bit of your background, because I'm excited to have this discussion today.
Thanks, Rick. I'm excited to be here. This is, again, like you said, a monumental thing for us to be able to have this discussion with your E-Trade audience. I'm Aaron Harding, as you mentioned. I have been in the financial wellness business for more than 15 years, and I'm currently the head of financial coaching for Morgan Stanley at Work. In that capacity, I help drive strategic oversight and management of the financial coaching function that we provide to our participants. And I'm happy to be here today.
Well, thanks, Aaron. You and I are really just going to have a discussion today, and I've just got to say that the partnership between or the combination now between Morgan Stanley and E-Trade is a fantastic combination. We both bring a lot of value to all of our pool of clients, but this is the first time that we're getting into what I would just say is basic financial wellness. And so what we're going to kind of walk through is things like budgeting and debt and credit scores. And Aaron, I think the best way to do it is just to jump right in. And, when you and I were talking, one of the things that you pointed out is that before you get into the details, that people really have to understand where they are. You want to maybe just hit on that a little bit?
Yeah, you actually hit the nail on the head, Rick. The first step in getting anywhere is to start with where you are. And for us, when we look at our financial journey in our lives, a lot of us will have the end goal in mind. Excuse me. We would like to be millionaires or billionaires. We would like to be able to retire at some point. We'd like to be able to put our children through college. But wherever our goals are, we have to take stock first of where we are today. And that's going to involve some really basic things like calculating your current income. It is the case where many of us will have a salary, so we know what our income is going to be on a day-to-day basis. But with the rise of gig workers and second jobs and all of those things, there are many of us who have a more variable component to our income. So it's important to first figure out exactly where we stand from an income standpoint so that we can start doing some of the basic math. At the most basic level, financial wellness and achieving our goals is simple arithmetic or subtraction. So it's starting with what we have coming in and then subtracting out what we're spending. So
Aaron,
that's actually, sure.
If I can interrupt you for just a second, I think that's such an important point. You said it's simple. I think sometimes people think that when they get into this budgeting and financial wellness, you almost don't want to take the first step because you feel like you gotta cover every base, check every box. But it really is a simple first step, isn't it?
It really is, Rick. And I can tell you from experience that I've worked with folks who have not earned very much money as frontline factory workers, and I've worked with folks who have been multimillionaire professional athletes, and I can tell you that no matter what the income level, that step of figuring out how much is coming in and how much is going out can be made simple. So some people will try to overwhelm themselves with complexity and detailed spreadsheets. But for us, at this starting point, the only thing we want to do is to calculate how much money is coming in and from where, so that we can then take a look at how much money is going out and where to.
Do you think that there's a requirement to have a more complicated budget, or is it really just as simple as an in and out balance sheet? And then if you start with an in and out balance sheet, how does it evolve at that point?
Yeah, that's a really good question. It's something that we hear on a regular basis. So let's say that step one is to just keep things simple. You don't want to overwhelm yourself with the work that you need to do. Keep things simple. But then if your needs arise and your needs change, or the budget isn't doing what you intended for it to do, you can add increasing complexity, like some of the tools that are available out there for you to aggregate your accounts, for example, and have budgets created for you based on your actual spending, or by developing more robust spreadsheets, or any of the tools that make sense to you. But the key is start simple and then move at a pace that makes sense for you based on where you are. Your budget is supposed to be a tool, and if it's too overwhelming, too complex, you won't use it in that way, and so it'll be wasted effort. The goal is to create something that you feel comfortable using and accessing on a regular basis. And I'll tell you, Rick, just to kind of take an early step, we will discuss a little bit later a framework that someone can use to create their budget in a way that makes sense to them. So many of you may have heard the 50-30-20. And what 50-30-20 basically says is that 50% of your income could be reserved for your needs. Those are the things that you need to live. So your car payment to get to work, your roof over your head, your clothing, your food on your table. Those things are the 50% needs. They're often also called essentials in some of the models that you hear, but that's the money that we have to spend regardless of how well or how poorly things are going for us from a financial standpoint. It's important to keep that in mind, because once you go beyond that 50% on your needs, then you're starting to create some financial fragility, which we want to avoid. That fragility creates stress for us because we start wondering where the money is going to come from to pay for our needs, and has an impact on our overall quality of life. So again, this is a guideline, but it's one that's based on science. 50%, no more than that spent on needs if we can do it. Now, next step is our wants.
Yeah, I go ahead and hit that, because as I'm looking at this, I know, and I want to let our folks joining us today know that we are going to be talking about debt here in just a moment. And I'm eager to talk about that, because that seems to be the elephant in the room that we've got to deal with. But yeah, continue on with that, because this is great stuff.
Absolutely, Rick. 30% of your budget can go to your wants. Those are the things that you don't have to spend money on, but they do improve your overall quality of life. So this is the money that you spend on your vacations. This is the money that you spend hanging out with your friends, taking your loved ones out on a date. This is that money that you're spending, also called discretionary spending. This is the money where you have a lot of control over how you spend it. But the point is that you should be spending some money on things that help make you happy and bring you joy, even though you are creating a budget for yourself. Now, if you find that you're not able to free up money for joy, then that's when it goes back to some decisions around how the needs stack up, how the income stacks up, and how everything works together. Now, the last component in this framework is 20% going to savings and investments. Now, this is, of course, assuming that you have debt. Well, statistically, the chances are pretty good that you have a student loan or a credit card bill or a mortgage or a car note or one of those things. But the key is making sure that we're not spending too much of our income on servicing that debt. Because again, once we start spending too much on that debt, that money has to come from somewhere. This model, 50-30-20, accounts for 100% of our income. So if we go over on managing our debt payments, then we won't have as much money to save. If we are saving and saving well, and we choose to save more than 20%, well, that money is going to come from wherever our needs are or wherever our wants are, and that's perfectly fine. That's about making decisions, which is the entire point of creating a budget. It's all about making conscious decisions about how you're spending your money on a day in and day out basis.
Well, you know, Aaron, there's so much to unpack here, and it's a shame that we're limited in the time that we have today. But let me ask you a couple of questions on this. I talk to a lot of people who live with guilt because their savings and investments is much less than 20%, if at all. It seems like that first 50-30 is actually 100. What do you say to somebody they just can't seem to break out of that rut of, at the end of the day, at the end of the month, I don't have the money for savings and investments?
That, Rick, is kind of the $64,000 question. And let me give you just a couple of things for your listeners to think about. The first one is that if you truly feel overwhelmed, then find a professional, a financial professional to talk to, because they look at it through an objective lens. And as a result, they may see some things that we don't see for ourselves when we are looking at our own money. The reality is that as we're looking at our money, it's emotional to us. We all have a relationship with money, and that relationship that we have may be driving some of our decisions. So some of the things that our brain is telling us, our heart is telling us are a need, may not in fact be a need. It's possible that sometimes we can move to a less expensive house without sacrificing our quality of living. It's possible that some of the things that we do for our children, when we have them, that we feel are needs because we want to give them a great life, are things that could be put on pause for a little while until we get more control over our financial life. So working with a financial professional is a really good way to have someone who can come in from the outside, take an objective view, and look at where you are and give you some suggestions on what you might be able to do to free up your circumstances.
It kind of reminds me of the person who was asked, how much money do you need to really make it all come together? And the answer was just a little bit more. We really, without a plan, without a discipline, to spend whatever shows up. And I think what we're talking about here, Aaron, is a good first step to making sure that just a little bit more isn't the answer that we're always coming back with. Let's hit debt for a minute, guy. I mean, you and I know that when we talk to folks that debt is just it, right? It's the thing that catches everybody. And I heard a saying one time, in the fitness world, there's a saying, you can't outrun a cheeseburger. and what that means is there are certain things that you eat that you just can't exercise enough to overcome the calories. And, I think about debt in the market, if we're getting, let's say on a good, consistent basis, let's say somebody gets 8-10% return, but they're paying 18 or 20% in credit card debt. There's literally no digging out of that hole. So maybe some thoughts on folks' relationship to debt.
The relationship that many of us have with debt is toxic at best. And the reason for that is that I speak with folks on a very regular basis who just believe that everyone has debt and will always have debt. So that's the first thing, right? Sometimes changing your behavior has to start with changing your perspective and your outlook. If you believe that you will always have debt, then it's almost guaranteed that you will always have debt in some form or another. That's the first thing. So next, as we're thinking about getting out of debt, one of the things that we talk to folks about is developing that plan that says, hey, I don't want to be in debt. I recognize now that I don't have to always be in debt. And so therefore now, what do I do? How do I structure my debt? How do I move forward with organizing the various debts that I have so that I can pay them off in a way that is optimal for me and beneficial to my financial life? But again, that first step starts with understanding where you are. It's about understanding what debts you have, who you owe, what the interest rates are on those debts, so that you can then formulate a plan. And Rick, I'll tell you that there are a lot of folks who, if you ask them what seems to be a very basic question from a financial perspective of what interest rate are you paying on that debt, they don't have a clue because they just pay the bills as they come in. And in many cases, they're paying the minimum because they have lots of other debts that they're dealing with. So to your point around them trying to balance out how much they're paying versus how much they could be getting from investments, they're not doing that calculus at all.
Well, Aaron, that is such an important point. I don't want to go past that too quickly. I know you have as well. I've worked with so many people, and debt, you phrased it perfectly. Debt is just a fact of life. In fact, I think they wouldn't know what to do if they didn't have a monthly interest payment, whether that's interest only or maybe nibbling away at the principal amount that they're in debt for. I think it's crucial that people understand that debt does not have to be a way of life. You can actually get to the point, like you say, you look at the cost of your different debts, whether it's student loans or maybe some kind of a collateralized debt or credit card, that sort of thing. Figure out where the money is going out, and you actually can get to the point where you'll see a month without a debt payment, and that's a good thing to strive for.
Absolutely, and people who reach that goal feel fantastic when they do.
Yeah.
But again, it starts with recognizing that you can do that. Once you recognize it and you organize the debts that you have, then you have to determine who you're going to pay and when. For many folks, if you speak with a financial planner, they're going to tell you to pay off the most expensive debt first. So the debt with the highest interest rate is the one that gets any extra money that you have to pay down debt. The reason is that paying off that higher interest rate debt keeps more of your money in your pocket over time. However, I've often found that the most expensive debt can also be the largest debt. And there are some of us, myself included, who need a win. And so people like me would organize my debt in order of smallest balance to largest, because I need the motivation of finally paying some debt off as quickly as possible. And so all my money goes to my smallest balance, regardless of what the interest rate is on that. I need that because I need to feel good about the fact that I'm making progress. And when your dollars are going towards that largest debt, it can sometimes feel like you're not making any movement, particularly when it's very large and it takes a long time for you to get there. But the real answer is, while one of those options may be better for your wallet, the true answer is that they both work for you in the long run. And so the goal is to choose whichever method makes the most sense for you, because that's the one you're going to stick with. You have to have the discipline that you spoke about earlier in this session to stick with making those extra payments to those debts month in and month out until they're gone. And I'll tell you, it gets hard sometimes. Sometimes you want to do a little bit extra for in the wants category and have some extra fun. Sometimes, you just need a break. Sometimes you'll see your income fluctuate, particularly if you're a gig worker or someone like that, and it gets tough to stick with it. But when you do, you see that benefit at the end. And when you are no longer making those debt payments, you have so much cash freed up on a monthly basis that you can start living more of the life that you had envisioned for yourself.
So many great points in here. I want to emphasize the fact that you mentioned that money is emotional. And if you feel defeated in this process, that's the easiest time to give up. So I like the idea of having some small successes, getting one of those creditors so that they don't even show up anymore. Great stuff. Let's shift gears a little bit now, Aaron, and something that we're told about all the time, and there's maybe not a clear understanding, but yet it is a crucial part of our financial picture. And that's the whole idea of our credit score. We see the advertisements about if you've got this credit score, then I love the way they do that. If you've got this credit score, then you can get more debt. But introduce us to the idea of a credit score and why we even care about it.
Rick, this is one of my favorite topics, and it's because there's so much misinformation out there about credit scores. So let's start at the very beginning. Your credit score is simply a measure of your likelihood to pay off a debt if someone lends you money, right? That's all it is. It's one measure that says whether you're likely to pay off debt if someone lends you money. but it has a ridiculously important role in our lives. There are some of us who, if our credit score isn't high enough, have impact to our job. Maybe we don't get the job we want, or maybe we're not able to keep the job we have. For all of us, though, our credit score has a significant impact on our wallet, because the better our credit score is, the lower the interest rate is that people are willing to charge us, because a high credit score says, in the past, I have paid my bills, so therefore I'm likely to pay my bills in the future. I'm less risky for them to lend money to. Now, your credit score, we hear about credit scores all the time, but there's more than one. There are several companies out there. There is one organization that is kind of the king of credit scores when we look at mortgage lenders, for example, or people who are making car loans, the things that we typically borrow money for as consumers. And that's really the FICO model, right? That's Fair Isaac and Company. They put out a model where they run your information and your credit history through an algorithm that calculates your likelihood to pay. And that score is a 3-digit number. Now, that number, as important as it is one of those things that people just don't understand very much. The first thing they don't understand is, well, how do I get a credit score? What factors into that number for me? And there are 5 things that have an impact on your credit score, but 2 of them have an oversized impact on your score. So let's talk about them. The first one is your payment history, right? That naturally means if you're paying your bills on time, you're less risky when it comes to paying things back. So therefore, it's a higher percentage of your overall score. Now, these numbers are closely guarded by the Fair Isaac and Company, but in a general sense, it's understood to be believed that your payment history accounts for 35% of your credit score. So if you want to see your credit score go up, simply make payments on time, right? And I say simply, right, that I'm being facetious, but if you could, you would. So make sure that you put extra effort towards making your payments on time, because that is the single most impactful thing that you can do to improve your credit score. The next one is your utilization rate. And your utilization rate looks at the limit that's been given to you on a credit card and what your current balance is. So the math is you divide the balance by the limit and you get a percentage. That number tells you what percentage of your limit you're using. People who are using a low percentage of the limit have a higher credit score than people who are maxed out on their cards, meaning that they're using a high percentage of the limit. Again, this is a risk measurement tool. So if you are near the limit on all of your credit cards, for example, then that will have a negative impact on your score. And the impact can be as much as 30%, because the utilization rate accounts for 30% of your FICO score. So again, when you look at the fact that there are 5 things here, those 2 alone that I just spoke about account for 65% of your credit score over time, which means managing those 2 is typically good enough to get you on the right path to good credit. And the other 3 items are things that are nice to haves that we can manage once we have the first 2 locked in.
Aaron, let me ask you on the utilization. It seems to me then that there could be 2 paths to improving that. One, of course, is to spend less on the card and drop that ratio. Is it safe to say that another path could be to increase your credit limit? Assuming that that's not for the sole purpose of just allowing you to spend more?
Yeah, exactly. And you said the right thing at the end there, Rick. Calling your credit card company and asking them to increase your credit limit can actually improve your credit score, because if you don't spend any more on that card, then your utilization rate by default goes down. Again, just given the math. The key is making sure that if you do that, that you have measures in place to make sure that you're not using that additional limit. It's extremely difficult for us with all of the marketing that we see that says spend, 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 consume, consume, consume. And we look at the fact that in the United States, at least, we are a consumer-driven economy. That makes it difficult to have that extra money there for some folks and not spend it. So if you have the dreaded D word, discipline, to increase your limit and not use those additional dollars, then by all means go for it. Call your credit card company and ask for it. If you know that you don't have the discipline, don't do it. Just build your credit score more slowly over time instead of trying to accelerate your progress, because the extra debt you take on may hurt you in the long run.
Another question. I'll kind of play advocate for some of the questions that I've heard in the past. Are there priorities in cards here? For example, is it important to have a major credit card like an Amex, Visa, MasterCard, or do you get the same benefit from, say, a store card or a gas card, or is there any value to combining them?
Yeah, that's another really good question, because when you think about it, store cards tend to be a little bit easier to get than a major card. And that makes sense, right? If you're looking at one of those major brands, a Visa, MasterCard, Discover, it's a little bit more difficult to get them because they have higher credit score requirements. So they're not typically starter cards for a person unless you're able to open an account at a bank, for example. Oftentimes when you're young, they will allow you to open a companion credit card account to help you on that path towards building your credit. So when you look at the hierarchy of quality of credit cards, the major credit cards are at the top of the hierarchy. Now, that doesn't mean that a store card or a gas card, for example, can't be useful to you. They can, because they're really good tools for you to build your credit. Now, one thing that people aren't aware of is that when you look at your payment history, the thing that the credit card company is looking for is payments over time. There are people who will tell you that you need to run up your credit card when you get one of those store cards or a gas card or something, run it up and then pay it down slowly over time. And what I'm saying is that you don't have to do that. Get one of those cards, use it for things that you would ordinarily have purchased using your debit card, for example, or cash, and keep that money to the side so that when the bill comes in, you can pay it off in full. So one of the things that I recommended for my son, who's in his early 20s, when he got his first credit card, I told him to buy a pack of gum on that credit card each and every month, or fill his tank once each and every month, because you don't need a large balance. You need on-time payments. So keeping that balance to a number that you can comfortably afford to pay off every month will build your credit score and also save you interest on many of those cards because of the grace period that they have.
So like in the instance of your son, somebody's starting off, and we have a number of folks joining us today who are in that stage of life, and they don't have a credit card yet. Do you think there is an imperative to, given the fact that utilization is such a large part of the calculation, do you think there is the imperative to say, you know what, you need to get a credit card, be disciplined, need to get one, rather than avoid the credit card at all costs? Where do you think the balance is in that advice?
So the balance is simply that I would never tell, a mass group that everyone needs to get a credit card, because the reality is based on your individual circumstances. So the first thing you have to determine is, are you ever going to need credit? And for most of us on the line today, the answer is yes, which means that we need to do some things to start building that credit. Earlier is better. Earlier is better because one of the things that factors into our credit score is our length of credit history, and that is determined by our oldest active account. So applying for a credit card today and getting it and using it is better than applying for it 10 years from now, because we'd be missing out on those 10 years of credit history. Now, having said that, there are some alternative methods that the credit scoring companies are starting to look at in determining what your overall credit score is. So they're starting to look at things like your rental payments or your utilities payments, which aren't typically included. But again, for something like that, because it's fairly new in the evolution of those markers being things that are included in your credit score, that you should work with your property manager if you are a renter and see if they report that activity to a credit bureau, and also the same thing for your utilities. Now, the last thing that I'll mention along those same lines is that credit is needed for things other than borrowing money. So if you're looking to rent an apartment in a complex, for example, they're going to run your credit score because it's an indicator of whether you're going to pay the rent every month or if they're going to have to evict you. So there are lots of things like that we go through. Turning on your utilities. In many municipalities, turning on your utilities, your credit score will determine whether you're required to make a deposit or not. And if you're required to make a deposit, what that deposit will be in a dollar value. So the goal for us is to start building that credit early just to be on the safe side, because we never know what life is going to throw at us. And again, it impacts us in so many ways. Additionally, it's going to impact, of course, our wallets directly in the form of the interest rates that we pay on things. Your mortgage rate will, all things being equal, your mortgage rate will be lower when you buy that home if you have a higher credit score than it would be if you have a lower credit score. If you have ever seen one of those commercials for an automobile where they give you the 0% down or the no payments for 2 months and those kinds of things, that fine print down the bottom often says for consumers with really good credit, and they'll determine it based on a number, which we can talk about in a few minutes. But the point is that our credit score has such a significant impact on our life and our wallets that it's to most of us, it's to our benefit to go out and start building our credit as quickly as possible. But the goal is to be disciplined in that. Again, you know yourself better than anyone else on this planet knows you. If you don't have the discipline to pay off that card on a monthly basis, then don't get it. Wait until you develop the discipline, the motivation to do that, because otherwise you could be putting yourself in financial jeopardy and moving yourself away from your financial goals instead of towards them.
Yeah, I'm glad that you raised that point, Aaron, that it's not just a dollar impact, that it is an accessibility impact. It's do you get that apartment? Do you get that contract? And let me ask you, there in any group of any size, and we've got quite a few people on joining us today watching this, you're going to have a certain number of people who have already made the mistakes, and their credit score is reflecting that, where they're not starting from scratch. They can't, they're not working with a blank slate and putting it together now. What kind of advice do you have for people who have made the mistakes? They've overshot their limit. They've been late making payments, and their credit score has suffered as a result. Is there any hope for them on building it back up, and what advice would you give to them?
Excellent question, Rick. And the first thing I'll say to those folks, excuse me, is that they're not alone. The reality is that there are many of us who have run into credit difficulties, debt difficulties, and have found a way out of it. So there's some good news. So we talked about credit scores, but we didn't talk about credit reports. Your credit report is simply a listing of all the credit activity that you've had, and it comes from a credit bureau. The good thing about your credit report is that information and its relevance in your credit score is limited. So the credit scoring models look at the most recent 24 months and give that the highest weight. Now, information stays on your credit report for 7 years. It'll have some impact on your credit score for 7 years in most cases. But after the first 24 months, that older information has less impact on your credit score. So if you've experienced some debt difficulties, some credit difficulties, one of the best things you can do is start making your payments on time now. Start working to lower your credit card balances now. Be responsible with the debt you take out now. And 24 months from now, you should see a much higher score than you have today if you're someone who's experienced difficulties. I have seen people increase their credit score 100 points in less than a year by getting really aggressive on their utilization rate by paying down debts while simultaneously making those payments on time every month to the debts that they have outstanding. Again, those two things are 65%. Focus on them. Know that it can be done. And again, I will say that this is one of those things where if you're deep over your head when it comes to the debts that you're facing, it might be worthwhile to talk to a professional who can help you make sense of what it is that you're doing and help you develop an overall strategy or plan for working through it. And if nothing else, having a relationship with that professional, they might be able to provide you with some occasional encouragement along the way, or serve as a sounding board as new things come your way, again, to help you keep on track and achieve your goal of becoming debt-free.
Well, folks, I want you to understand that one of the reasons that Aaron and I are spending so much time up front here talking about things such as debt and expenses and budgeting is because, the rest of this day, we're going to be talking about investing. We're going to be talking about savings. And the fact of the matter is, it's very difficult to begin that journey if you haven't gotten the other pieces in place. So what do we want to consider? It's like, okay, great. We're working on our credit score. We're paying down debt. And believe it or not, I've got a little money left over. Now what do I need to start thinking about?
Yeah, Rick, before I do that, let me go into one thing that you said that really, really hit me.
Sure.
I've seen it many times before where someone would start investing before they had their budget, debt, and savings under control. And what inevitably happens is that something happens in their life that makes them sell the investments that they have, oftentimes at a loss, because we typically need to sell investments during bad times. And so it completely wrecked their overall financial journey simply because they got the timing wrong. So you're absolutely right that we want to get the basics covered before we start moving really forward with our investing. But we also want to make sure that our investing is in our plan from the start. So as I'm thinking about my credit, as I'm thinking about my debt, as I'm thinking about my budget, I want to make sure that I'm carving out a small piece for small investments so that my investments can also be building over time as I move forward in my financial journey. Now, one of the first places I want to be saving for is an emergency fund. We know that life is going to throw things our way, and an emergency fund will keep us from selling those investments in many cases that we needed. And I'm not talking about the massive emergency fund that many of us financial planners typically recommend. I'm not talking about 3 to 6 months of worth of expenses as your first target. I'm saying $1,000. Save $1,000 and you'll have enough to replace a tire that blows on your car, or to have a refrigerator in your home fixed if you need to. $1,000 goes a long way, and starting with that as your emergency savings fund is really important. Now, once you have the $1,000, then I wholeheartedly encourage that you save that 3 to 6 months worth of expenses that you'll hear many financial planners recommend for you. But again, let's start with the basics and making sure that if something happens today, that you're able to cover most of those smaller expenses in life. And again, many of those emergencies are. We also want to be thinking about, as we're looking at our plan, we also want to be thinking about some of the short-term purchase goals that we have. You may want to buy a car in a few years. You may want to take a vacation in a few years. You may want to buy a ring for your future spouse in a few years. Those short-term purchases are, again, things that we want to factor in, along with some of the big major expenses. Now, some people might say that that ring for your future spouse is a major expense. That is a decision that you will make around how much you spend on that. But homes are expensive. Education, unfortunately, can be expensive. Doesn't have to be, but can be. And retirement for all of us can be very expensive. When you think about retirement, one of the ways that I often think about it is that we work for 30 or 40 years to not work for 30 or 40 years. And that means that we have to amass a nice chunk of change that we can dip into as we're living those 30 or 40 years with no income other than what we've provided or what the government provides for us in the form of Social Security. So again, that's one of those things where the earlier we start thinking about our retirement and savings, the better off we're ultimately going to be, because the power of compounding interest, the value of time, all of those things make putting in the dollars earlier a better idea than putting them in later.
Well, Aaron, you mentioned about time, and let's now let's talk about this. I like this slide, time is money. You know, in the same sense that debt over time works against us. In other words, the more time that goes by when we have debt, the greater our debt becomes. It works to our benefit, too. You want to talk a little bit about why it's important to get started early and how that even just those few extra years can make a difference?
Certainly, Rick. It is the double-edged sword of interest. When we pay interest, it's bad for us financially. When we earn interest, it's great for us financially, and particularly when it compounds over time. And so if you look at the graphic, you'll see that we have three investors who put in essentially the same amount of money over time. $123,000, $124,000, $126,000 over time. But the difference between the investor who put the money in earlier, which is Alex in the green, and the investor who started saving latest, which is Taylor in the blue, is almost $600,000 by the time that they start taking that money out at age 70. Now, that is just simple math. Right? There's a quote that people attribute to Albert Einstein that compound interest is the greatest mystery of the world or the greatest invention in the world. I don't know if he said it or not. I never met the guy. But I will say that that quote is fantastic because the sooner we start getting our money in, the more time it has to work overtime. One of the things that people often think about with investing is the fact that investments go up and down, particularly in the stock market. But when we look at those stock market charts since, back in 1929, when those charts were first being developed, the market does go up and down, but it does so with an upward trend, or it has done so with an upward trend. Now, the fact that it did that in the past isn't a guarantee that it's going to do the same thing in the future, but there is a case where history often repeats itself, particularly over the long run. So for that person who can get that money in and have it invested for 40 years, 50 years, 60 years, they have a greater opportunity to have more at the time when they need the money the most.
I want to tease out a little bit of what's coming up later today in another session. Dave Whitmore is going to be bringing a session, and in that he talks about the rule of 72. But I think this is a good place to introduce it the first time. The rule of 72 is that if you have an interest rate that you're earning on your investment, let's say it's 10%. The rule of 72 says take 72 and divide it by that interest rate, that return, and that's how many years it will take to double your value. So for example, 72 divided by 10 is 7.2. If you can earn 10% year over year over year, then your money will double in 7.2 years. And I think this is a good way for people to wrap their heads around the fact that it doesn't take an extraordinarily amount of time to see a difference, but yet as you get further down that line of investing, it becomes more and more apparent. Kind of like, and Aaron, if you want to comment on this, kind of like when you start a little bit of debt, it doesn't feel like it's that bad. And then 5 or 10 years down the line, you're looking back saying, how in the world did I get here?
Absolutely. And again, it's that double-edged sword of interest. And on the investing side, when it is working to our favor, you're absolutely right that rule of 72 gives us a good viewpoint of at least having some perspective on how long it'll take the money to double. But the important takeaway from that is that once the money does double, you feel different about it. And feeling that wealth that comes from having your money start accumulating over time can provide a high degree of comfort to many people. Now, some folks will see the account balance grow and say, I want it to grow even more. But many of us will look at the account balance grow and start breathing that sigh of relief. Okay, my goals are in sight now because the money is accumulating in a way that makes sense to me and is according to my plan. that money is accumulating. And so now I can breathe a little bit easier around some of the negative relationship things that I've had with my money that now allow me to look at it in a very different way. So that rule of 72 can also help us figure out not just when the money will double, but when we may be able to breathe a little bit easier as we're thinking about our finances.
You know, it's one of the themes that's coming out here, Aaron, that we emphasize as well. In fact, one of the sessions that we do on a normal course of our education is called Managing Your Mind. And it addresses how big a role our thinking and our emotions play into finances. And you know, as we're coming into the final part of the discussion here for this first session, I just want to remind people that you've got to get the right framework of mind. If, for example, if you start saving money and something changes down the line, it's okay. You can give yourself permission to maybe put your savings on hold for a little bit. Maybe something happens and you've got to dip into the emergency fund and you just don't feel like, you don't feel like you can continue saving. Aaron, I know you'd agree with me. It's okay to adjust to life without guilt. Any thoughts on that?
Not only is it okay, Rick, it is expected. As things change for you financially, you should be making changes to your money. You should be thinking about things differently. I'll tell you, I'm a certified financial planner, but I was never perfect with my money. When I was younger, I made the same mistakes that a lot of younger people do. I didn't invest as well. I ran my credit cards up on ridiculous things like clothes and going out to dinners and hanging out in the nightclubs and those things. But I had the benefit of time that allowed my thinking to change, and I developed more of a savings-oriented mindset as opposed to a spending one. And you're absolutely right that there are times in our lives when things will be a little bit more difficult for us. Personally, I had a period where I was out of work for 2 years. Now, I was fortunate enough to be able to rely on an emergency fund that I had amassed before that happened. But I had some tough decisions to make during that time. I had a couple of young kids. They did after-school activities. Those activities were not inexpensive. I had to make some decisions around which of those activities continued and which wouldn't. Had to make the tough decision. It was heartbreaking to tell my child that she couldn't continue with this activity that she loved, but it was temporary. Eventually, things turned around. I got a job. I rebuilt some savings, and the activities were able to be restarted. But it's perfectly normal that life is also going to go up and down for you. I hope that it doesn't, right? I hope that everyone on this call sees nothing but prosperity from today forward. But statistically, again, at least some of us are going to experience some down things, and you have to be willing to make those decisions without guilt, which is, again, where a financial professional might help with that. One of the things that they bring is objectivity, and that objectivity can help you to distance yourself from the decision somewhat, because you know that the decision that's being made is the best for the circumstances at the time based on your consultation with your professional.
Yeah, I've spoken with young people who think that there is a cultural or societal expectation that you get out of college, you get a professional job, you get your raise every year, everything progresses forward. And if there's a hiccup in that, if they have to start with a job that maybe is not aligned with what they studied, or if they have to switch jobs and you got to take 3 steps back in your earning power, that's okay. I want to, whoever's listening to this, I want to encourage you to not give up. This is really a journey. This is not fill in the boxes, check every box exactly the way it's, quote, supposed to be. Aaron, you've referred to this a couple times. Everyone's unique. Everyone's situation is unique. And it's a journey that you've got a lot of decisions to make, but they're there for you to take advantage of, so that you say, listen, I'm gonna invest here. I'm gonna save here. I'm gonna cut back here, and it's there's always help somewhere. Now, as we wrap up here, Aaron, as I said, the rest of today, we're going to be talking about things like basic products, exchange traded funds. What's a stock? How does the market work? We're going to finish the day, in fact, talking about some alternative investments. Those of you who may have joined today thinking that we're going to talk about cryptocurrencies, well, we're not going to talk a lot about them, but we are going to show where they fit in the grand scheme of things. But Aaron, at some point, somebody's got to make a decision. Okay, I've done this. I'm ready to go here. And there really are a lot of ways now where somebody could enter into a disciplined savings. It's not just a matter of going out and finding a broker anymore, as it was, perhaps 20 or 30 years ago. Do you have any thoughts for folks as to, what to look at first? What do you look at technology-wise? When do you look at somebody to help you? Maybe some thoughts and discussion around that.
Yeah, this is, again, one of my favorite topics, Rick, because I realize that not everyone's going to be able to go it alone in their financial journey. And uncovering the right resource at the right time is immensely powerful to our ability to achieve our financial goals. Now, the first thing I'll say when you're looking at the options that are available to you, from self-directed brokerage account to a digital investment platform to a virtual advisor to a dedicated financial advisor who works with you, to thine own self be true. That's the first thing. If you're someone who is knowledgeable about investing and have experience with investing and have the time to invest and have the temperament to invest, then maybe self-directed brokerage account is the way for you to dip your toe in the water by you going in and selecting a few investments that work for you. Now, I'll tell you, that's how I started. I don't think I ever told you this, Rick, but I was an E-Trade customer back in 1998, maybe 1999. But I was in graduate school getting an MBA in finance. So the E-Trade account made sense for me because I was practicing the things that I was learning in the classroom with real dollars. A small amount of real dollars, but real dollars nevertheless. But it was really for practice. It didn't make sense for me to be working with an advisor given what I was trying to do at the time. Now, I'm a little bit in a different point of my life. I have been working for many years, and although I'm a certified financial planner, I work in the financial industry, all of those things, I just don't have the time to manage my money anymore. Yeah. So while I believe I have the talent and the temperament to do it, I don't actually have the time. So that's another thing that makes me say, well, you know what? Maybe I should be working with a dedicated advisor. And, excuse me, and that time, temperament, talent is one of the things that I learned from one of my E-Trade colleagues recently, is how you look at when a person decides whether they're ready for a dedicated financial advisor. If you don't have all three, then maybe you should be working with someone who can help you out. If you have the time, temperament, or talent, then maybe you choose to go the self-directed route. Now, the digital investment platform and the virtual advisor, those are kind of in the middle alternatives that can allow for you to get some of the help you need in a way that's going to make the most sense for you. And so, again, just make sure that you know yourself, you know whether you have the time, temperament, and talent, and you choose the path that makes the most sense for your situation. Again, going back to Rick's point, it may change over your life. I can personally say that all four of these have been used by me at some point in my life as I've worked through my financial journey.
And Aaron, I've also seen people who've been quite successful mixing and matching. For example, they may have the lion's share of their investments professionally managed, but yet they have an interest in keeping their finger on the pulse of the market. And so there's a small portion that they self-direct, and it lets them feel like they're participating, but at the same time taking advantage of someone who, yeah.
I agree completely, and I actually did that for some time. I actually called it the save me from myself strategy. I'm a very, very big risk taker, and so if I have all of my dollars being self-directed by me, then there's a possibility that I make some really poor financial decisions over time. So having a piece of the money managed by a professional that I didn't have to think about as much, and a smaller piece of what I called play money, that if I made some bad decisions because I was being extremely aggressive with those dollars, it didn't derail my financial plans. And if something really hit and hit well, then it was just icing on the cake. So you're absolutely right that people may use a few different methods as they work through their financial journey. Sometimes there'll be overlap as you transition from one state to another. But as you mentioned, sometimes it is an actual decision to have your money split up across a variety of platforms because it's doing different things for you at that time.
Well, Aaron, we are coming down to our time limit. First of all, I want to say thank you so very much for joining us. It's just a fantastic opportunity for us to be able to offer this out to the folks joining us today. Just even people who are more experienced, you know, it's a good idea to come back to the basics, to just remind yourself of what's important. And folks, stick with us for the rest of today, because we've got a lot to cover. As I said, learning how the markets work, learning about different products. We're going to be taking some time in the middle of the workshop today to go over the platforms. We're going to be looking at the mobile platform. We're going to be looking at ways that you can do your research and trade. But in any event, thank you folks for joining us. Aaron, thanks so much. I think we're going to have to do this again.
I would love to, Rick. Thanks for having me.
All right. Folks, we'll take a quick break. We'll be back with our next session shortly. Thank you very much. On behalf of the investor education team at E-Trade from Morgan Stanley, thank you for joining us today.